Let's take a look at the FTSE. Like I mentioned to you before, with equities, historically, the week leading into Christmas, there has historically been a Santa Claus rally, and this is confirmed by our friends at Equity Clock. Just taking a look at the FTSE on the weekly time frame, we can see here that we've got the all-time high tested last or made in 2015, April 2015, so about a year and a half ago. We've tested this all-time high since Brexit, when the pound devalued sharply against the US dollar and made UK equities far cheaper and more accessible for foreign investors. We've seen a surge in UK equities since then in price, but price has failed to break that all-time high. And historically, ever since good reporting and market analysis begun, we've seen an emotional high going into Christmas with equities, and traditionally that has played out in the markets. So we're about 100 points away from the all-time high, and I'm pretty sure that given past behaviour of the market being potentially a good indicator as to what could happen again in the future, we can reasonably expect the Santa Claus rally to trigger in a potential sell order on the level here. So those supply and demand traders looking to sell a power zone here, which is of course the all-time high, has been validated by having one test, two tests. Will we get our third test of the Santa Claus rally? Well, let's take a look here at our friends Equity Clock. Let's go to UK equities and show you, because this has given us a very good litmus test over the past 20 years as to how equities have performed. And the FTSE is no exception to this. So in December, we can see that traditionally, leading into Christmas, from the midpoint or middle of December, we've seen a sharp rise historically, and that correlates with potentially the rise we should expect or hope to get prior to the triggering of our trade at this all-time high level here, coupled with the movement which we're looking to take advantage of, a reversal in January. Historically, equities, not least the FTSE, have been bearish in January as the New Year's hangover comes into play, and we see equities falling in value. So that correlates very nicely with our charts here. And those people who are familiar with the supply and demand strategy based on power zones, typically what we do at hard levels of resistance, i.e. this level here, which typically take place at multi-year highs or lows, in this case as an all-time high, we would have our orders placed just below their number at 7,098 or 85, depending on how likely you want to be triggered in. Like I mentioned to you, if you put it right on or above the all-time high, it's very unlikely that the market's going to trigger you in. I'll put it in slightly below the level and give yourself enough breathing room for a false breakout, like 100 or 200 points away. I'd recommend your target, sorry, not your target, your stop to be. So potentially entry at 7,080 and your stop loss at 7,000, up here, sorry, 7,180, for example. As a decent stop, or even 200 if you want to be extra safe. Okay, so this chart correlates. This is a huge ceiling in the way of price going further upwards in direction, so we can reasonably expect price as and when and if it tests this level to potentially turn around, given that price has never been above this level in history, given that we're also backed up with the fundamentals. Not only do we have a bearish reversal divergence supporting our sell argument on the RSI setting 6 and also on the stochastic, I would like to reiterate this is a high risk trade. It is a reversal trade, so 80% of reversals do fail. However, if we look at potentially one of the best setups we've had to sell in history since the FTSE, or since 1996, if you can see here that we're at the top of a very well-established long-term range, and we're looking to sell here at the very top of this long-term range. And if we do see a flash crash in 2017, then we're very well placed to get it at the most efficient point at the top, at the very top of this long-term all-time high here in this, at the top of this range here. Remember that if we do see a flash crash and equities, even if they fall down to here, a quarter of the way through this long-term range, then we've got jaw-dropping reward to risk. Remember, if we've risked, say, 100 points on this, and we're entering at, say, 780 or 7,080, my apologies, and we're looking to exit at 6,071, we've got 1,000 points to be taking advantage of, divided by, that's a 10 to 1, divided by 100, what we're risking, it's a 10 to 1. Risking 2%, that's a 20 to 1 if we're looking to take profit at this point. And this is only a quarter way of the way down through this long-term range. So remember that 20, 40, 60, 80% potential gain on that trade, risking 2%. That's not a bad hedge, is it, to your stocks portfolios? And remember that at the very bottom here, this level hasn't been broken since 1995. So this, if as and when price comes all the way down here, this will represent a fantastic buying opportunity for us again. Okay, so there's minimal downside if we're thinking of just risking 2% on this reversal trade. Remember that, like I just mentioned to you, and I'll say it again, in fact I'll shout it from the rooftops until I'm blue in the face. Reversal trades are only 80%, 80% unsuccessful and 20% successful. So it carries a much higher risk, but if we're able to get a tight entry at the very top here, at the all-time high, we're able to get in at the very start of what could be a longer term move to the downside, then we will potentially benefit from very handsome reward to risk.